Elsa Lignos. She's a foreign exchange strategist at RBC, and she joins us now from London. Great to see you.
Great to see you too.
Let's talk about these higher oil prices, Elsa, how they contribute to inflation directly. How is what OPEC Plus is doing going to make the Federal Reserve's job even more challenging?
Well, the challenge, as you rightly highlighted, is that so many of these commodities priced in dollars and form a big part of headline inflation. Not so much core inflation, but the second round effects also matter to consumers. It puts political pressure on governments and it puts pressure on central banks that then have to respond with higher rates, even as economic activity is slowing down.
Yeah, this is certainly going to make, because oil is traded in dollars, it's going to make it really difficult to keep inflation in check globally, isn't it?
Absolutely. And I think beyond that, it also tightens financial conditions for a lot of countries outside the US. Now, the Federal Reserve is the central bank for the US, but of course, the actions they take have an impact on the rest of the world. And we see that effect in emerging markets. We also see it in a lot of G10 markets. And so the strength that we've seen in the US dollar year to date has a flip side, the weakness in a lot of emerging market and G10 currencies. And that's put a lot of pressure on, for example, borrowers that had borrowed in US dollars and now have to pay that back in much more expensive terms.
What do higher oil prices mean, Elsa, for your expectations about the Fed's rate path going forward? Could this cause the Fed to pursue an even more aggressive path? I mean, many would say that it's already being aggressive, but now that its job is becoming more difficult.
Right. So I think the really interesting conversation at the moment, the one that's been dominating markets, certainly in the last few days, if not weeks, is the question of a Fed pivot again. Will the Fed switch up its approach, take a slightly softer approach given the slowdown in economic activity? When oil prices move higher, it becomes a lot harder to envisage that Fed pivot. Even if economic activity is slowing down, when higher oil prices are putting pressure on inflation, the Federal Reserve really has to keep rate hikes going until they're absolutely sure and convinced that inflation is moving lower. And sadly, that it's premature at the moment in their eyes to make that call.
In focusing on raising rates to cool inflation, do you think that central banks have overlooked the importance of maintaining stable currencies?
Well, when it comes to, for example, the US, because so many commodities are priced in US dollars, and because actually a lot of US exporters sell their goods in US dollars, the strength of the currency doesn't pose the same kind of problem it might for other countries. And so, yes, central banks have to take into account, the strength of the currency or the weakness of the currency when looking at the inflation outlook. But outside of the Federal Reserve, the tools that the central banks have in order to affect the currency are actually fairly limited. You look at the Bank of Japan trying to intervene to support the yen, and you still see a lot of weakening pressure on the Japanese yen because they just can't keep pace with the interest rate rises in the US.
All right, Elsa Lignos with RBC, thanks so much for your perspective today.